Starbucks stock is down 22% this year, taking the company's market cap to $85.5 billion, with $4.1 billion of cash and investments and $15.6 billion of debt on the balance sheet. The enterprise value is $97 billion. Revenue over the last 12 months comes to $36.5 billion, with just over $4 billion of net income and $3.8 billion of free cash flow. So the stock is currently valued at 21 times earnings and 25 times free cash flow. That valuation doesn't look particularly appealing when looking at the company's recent performance. Total returns in the stock are now negative 14% over the past 5 years. In the latest quarter, US same-store sales fell 2%, and the same metric in China was minus 14%. From a top-down perspective, it looks like Starbucks has lost its way. The company's goal to be a third place between home and work seems to have faded. Locations are less comfortable and customers are spending less time there. The mobile app and the drive-thru now account for more than 70% of Starbucks sales. The company is facing boycotts for political reasons, and workers' unions in the US threaten margins. There's simply a view that Starbucks is not as unique or fresh as it once was. That has opened the door to competition from the likes of Dutch Bros, McDonald's and Luckin Coffee in China. However, while same-store sales in China were down 14%, Luckin Coffee did even worse with a 20% decline, so it's possible that inflation and competition from smaller independents is the bigger issue. On the positive side, Starbucks does have a plan to reignite growth. The triple shot with two pump strategy has been designed to minimize cost while elevating the brand. The company plans to renovate stores, double rewards members, and open 15,000 new stores by 2030. That's a 40% increase from the total store count right now. Crucially, Starbucks needs its plan to succeed because the company's debt pile is growing and becoming a burden on future returns. A simple discounted cash flow model that anticipates 10% revenue growth for 10 years, a free cash flow margin of 11% and a discount rate of 10% points to an expected annualized return of just 7.4%, with a fair value below the current stock price. Original founder Howard Schultz is clearly skeptical of Starbucks' recent decisions. Meanwhile, activist investor Elliott Management will want to make its mark and try to turn things around. But at this point in time, Starbucks has a lot of work to do and long-term debt will remain an issue. But these are my personal opinions, not financial advice, and I hold no position in Starbucks stock. For more investing videos, make sure to join my newsletter at 3minutebreakdowns.com. Thank you for watching.